Imagine betting against the very roof over your head, actively profiting if your most valuable asset, your home, plummets in value. It sounds absurd, perhaps even self-destructive, yet some individuals have devised complex financial strategies to do precisely that, to short their own house, not by selling it, but by making a calculated bet against the broader housing market while still residing in their property. This isn't a simple wager, it's a deep dive into the arcane world of financial derivatives and market speculation, often born from a profound conviction that a housing crash is imminent. By the end of this video, you'll understand the intricate mechanics behind short selling, how institutional investors and even some individuals attempt to profit from market downturns, and the specific financial instruments that make such a seemingly contradictory move possible. More importantly, you'll learn what lessons this high-stakes strategy holds for your own financial planning and how you can protect your assets, including your home, from market volatility. At its core, short selling is an investment strategy that speculates on the decline in an asset's price. Unlike traditional investing, where you buy low and sell high, short selling involves selling high and buying low. In the stock market, this means borrowing shares of a company you believe will decline, selling them at the current market price, and then, if your prediction is correct, buying them back later at a lower price. The difference between your selling price and your buyback price, minus any fees, is your profit. For instance, if you short 100 shares of XYZ Corp at $50 each, selling them for $5,000, and the price drops to $40, you buy them back for $4,000, pocketing a $1,000 profit. The risk, however, is theoretically unlimited. If the stock price rises, you could face immense losses, potentially far exceeding your initial investment. Applying this concept directly to a physical house is impossible. You can't simply borrow your neighbor's house, sell it, and buy it back cheaper. Real estate is illiquid, unique, and not easily traded like stocks. Yet, the underlying principle, betting against an asset or market segment, can be applied to real estate through more sophisticated financial instruments. This brings us to the broader housing market, a sector often seen as a bedrock of personal wealth, particularly in the United States, where home equity represents a significant portion of many families' net worth, often exceeding their 401k or Roth IRA balances. The U.S. housing market has historically shown incredible resilience and growth, with median home prices increasing by an average of around 4 to 5% annually over the long term. However, this growth isn't linear. We've witnessed periods of dramatic appreciation, like the early 2000s, followed by severe corrections, most notably the 2008 financial crisis where national median home prices plummeted by over 27% from their peak, wiping out trillions in equity and significantly impacting FICO scores for millions. Understanding these boom and bust cycles is crucial for any investor, and it's precisely these vulnerabilities that those looking to short the housing market seek to exploit. So, how does one actually short the housing market? It's not about directly shorting a specific property, but rather taking an inverse position on the performance of the real estate sector. One common approach involves real estate investment trusts, or REITs. These are companies that own, operate, or finance income-producing real estate across various property types. They trade like stocks on major exchanges. If you believe the housing market, particularly residential or commercial segments, is headed for a downturn, you could short residential REITs or even broader real estate sector ETFs, exchange-traded funds, that track real estate indices. If the market declines as predicted, the value of these REITs or ETFs falls, and you profit from your short position. Another, more complex method, particularly relevant to the 2008 crisis, involved derivatives like credit default swaps, CDS, and collateralized debt obligations, CDOs. While these instruments are typically traded by institutional investors, understanding them illuminates the mechanics of betting against an entire market. A credit default swap is essentially insurance against a bond default. In the context of housing, investors could buy CDS contracts on bundles of mortgage-backed securities, MBS, or CDOs, betting that the underlying mortgages would default. If mortgage defaults surged, the value of these MBS and CDOs would collapse, and the buyer of the CDS would profit handsomely. This was a key strategy employed by figures like Michael Burry, who famously predicted the 2008 crash. Now, for the central mystery, the man who shorted his own house. This isn't a literal transaction where someone sells their house and buys it back cheaper while living there. Instead, it refers to a sophisticated hedging strategy. Imagine a homeowner who owns a $600,000 house, representing 70% of their net worth. They are deeply convinced that the housing market, perhaps due to rising interest rates or economic instability, is poised for a 20% correction. While they don't want to sell their home and move, they also want to protect their concentrated wealth. This individual might then take a short position on a basket of residential REITs or an inverse real estate ETF, with a notional value equivalent to a portion of their home's expected depreciation, perhaps $100,000 to $120,000. If the housing market indeed drops by 20%, their home's value might fall by $120,000. However, their short position on the inverse ETF or REITs could generate a profit of a similar magnitude, effectively offsetting a significant portion of their home equity loss. They've essentially hedged their concentrated real estate exposure, allowing them to remain in their home while financially benefiting from their market conviction. This requires significant capital and a margin account, as short selling requires collateral. However, this strategy is fraught with immense risk. What if the housing market continues to climb instead of falling? If that $600,000 house appreciates by 10% to $660,000, the homeowner gains $60,000 in equity. But their $120,000 short position could lead to catastrophic losses, potentially wiping out their gains, or even a substantial portion of their liquid assets. Short selling has unlimited loss potential, meaning theoretically you could lose far more than you initially invested if the asset price continues to rise indefinitely. Margin calls, where your broker demands additional collateral to cover potential losses, can force you to sell other assets at unfavorable times. Timing the market, especially a complex sector like real estate, is notoriously difficult, even for seasoned professionals. The core lesson from this audacious strategy, however, is not to encourage homeowners to short their own assets. Instead, it underscores the critical importance of diversification and prudent financial planning. For the average American investor, tying up a vast majority of their wealth in a single, illiquid asset like a primary residence carries its own inherent risks, regardless of market direction. A more practical approach to protect your financial future involves maintaining a robust emergency fund, building a diversified investment portfolio across stocks, like through an S&P 500 index fund in a 401k or Roth IRA, bonds, and perhaps a high-yield savings account, HYSA, rather than being overly concentrated in real estate. It's about ensuring that a downturn in one asset class doesn't derail your entire financial plan, a principle the IRS implicitly supports through various tax-advantaged retirement accounts designed for long-term growth and diversification. The man who shorted his own house wasn't simply gambling, he was executing an extreme form of portfolio hedging based on a deep, albeit risky, market conviction. His story highlights the power and danger of complex financial instruments and the profound impact of market cycles on personal wealth. For most of us, the takeaway isn't to mimic his specific strategy, but to understand the principle: never put all your financial eggs in one basket, and always be aware of your concentrated risks. If you want to understand how everyday investors can truly protect their portfolio from market crashes through practical, accessible strategies, check out our next video on recession-proofing your 401k. Until then, remember, even the most audacious financial bets often hinge on fundamental principles of risk management and diversification, principles accessible to us all.